hopefully we will finish the chapter 1 and 2 handout, although we might not. We'll see. So this is what we're going to do today. So first things first, we're going to do this one, and then we'll do this one. Okay. And I'll take care of this later. All right, so today, let's see, let me pull up the, so classical sampling. So there should be something that looks like this. And let me talk a little bit, just briefly, just about about sampling in general, actually. So in sampling, I know you guys have probably had this before, but sampling, you take a small group and you project it over the entire population. So you take, for instance, if you have a medicine, let's say you have a cold medicine, and you can't test it on, all 8 billion people on the planet. So what you do is you take a small group and you go, okay, this cold medicine works on, 38% of these people. So then we can project it over the entire population, after, a few tests, obviously, but you take a small sample group and then project it over the entire population. And you can get fairly good numbers doing that. It's kind of surprising at how, it's not too difficult to get in the 95% level or even 99% level of sampling accuracy if you're taking a fairly small population. Now, in auditing, we do this for two different reasons. The first reason being is that it's usually much more efficient. You can get 99% sure in a very quickly by taking a small sample and then projecting it over the entire population. Okay. There's also some things that we cannot test 100%. I think I've talked about this before. If you're auditing, say, Walmart, it's impossible to do a complete inventory on Walmart all in the same day. There's not enough auditors in the world probably to do that. So there are some companies that are so big that it's a necessity to do sampling. You cannot do it any other way. Okay, so let me get back to the sample. Okay, so here is classical sampling. Here are all the accounts. So these are all the accounts, and this is what the client gave us. So these are the client numbers over here. We asked for the accounts, they use what they gave us. Now, these are the audit amounts, and these are the amounts that we would get if we were to pick any one of these. Now, we're not going to pick all of them, but if we were to pick one, for instance, this first one, the amount is $36.75, and if we audited it, it would be $36.75. So, this is what they gave us. This is what we would figure out if we were auditing it. Now, again, we're not going to take all 30 items. We're going to take a sample of them. Okay, which leads us to our first problem. How do we choose our sample? We're going to take 5 of these accounts. For testing. Okay, now, and we want this to be, these to be random, and we'll talk about that in a second. Actually, I'll talk about it right now. Picking a random sample, you guys have, if you have had sampling, I'm sure you guys could probably tell me this, but you want a random sample. Why do you want a random sample? A random sample more accurately depicts the population as a whole, rather than one that's, say, biased. So you want kind of an unbiased sample because that's going to be the best representation of the population as a whole. So that's what we're doing. We're picking a random sample. Now, here's the weird thing about auditing. I didn't say weird, but here's part of the thing about auditing. Everything you do in auditing must be repeatable by somebody else with the same result. So you can't just come up with a set of random numbers and use that, and nobody else knows what those numbers are. You have to be able to have a random sample, but somebody else has to be able to come in and use that same random sample and come up with the same results. Now, they'll come up with the same results. They won't necessarily come up with the same judgment about them. What I mean by that is, if two different people do the same sample, maybe they come up with the same result. Let's say they say that the books are misstated by $18,000. Okay. Now, two different people should be able to do that sample and come up with exactly that same 18,000. Okay. So that is the same result. Now, the judgment comes in as is $18,000 material. That can differ. One person could say it is, one person could say it's not. It's a judgment. But the results itself from the sample should be exactly the same. And so whenever you're doing auditing, you're documenting how you did it. So how did I come up with this random sample? You have to document that. It's because someone else is should be able to come in and do the same test and get the same results. So it must be repeatable. Okay, so what we're going to do here, down at the bottom of the page, we have a random number table. Now, notice that these account numbers are pretty specific. It'd be very difficult to match up any of these account numbers to the random number table. They're probably not even on there. But what we did here is we numbered them on the side, and there's 30 items. So out of these 30 items, let's make that green. Out of these 30 items, we're going to pick 5 of them. Okay, and it tells us how to do it up here. First 2 columns. Okay, so we're going to use the first 2 columns in the table. Pretty sure the table up on top. I don't know. Okay, so here's the random number table. We're going to use the first 2 columns. And we're looking for items 1 through 30. So the first two columns, we have 3. So do we have a 3 on the table? We do. It's right here. So this is going to be our first one that we test. Okay, so the first item we picked in a random table was 3. Okay, do we have a 46 on the table, on the accounts?
No.
So we're going to skip that one. We don't have a 51 either. So what's the next one we're going to pick?
11.
Yep, good. So we're going to pick number 11. 14. 18. 91. 28. Check and make sure I didn't miss anything there. I think that's it though. That's a 5? So 3.
Yeah.
Okay. All right. So what I'm going to do is I'm just going to copy and paste these down. So here's the number 3. The audit amount is same. over 11. What am I gonna do? I can probably just copy both of them. Let me see if I can do them both at once. Are we making this harder than it really is? And 28. All right, I might be able to move this up. I think I just realized I might have done a. I may need an extra row here. Okay, I think those are, let me check, make sure. So 3, 11, 14, 18, and 28. Okay, so this is a random number table, and this, notice that anyone taking the first two columns of this random number table will pick the same items. It'll be a random sample, but we'll pick the same random sample. It sounds strange, but it's a random sample. So these are random numbers, but they are. But if we choose them, if we use the same column, we'll pick the same numbers. There are other ways to pick random samples. You can certainly do computer programs. You can do random samples and stuff like that. And if you do it on a computer, what you do is you pick the random sample, and then you lock it in. You copy that as just values, so that someone else will use those same values, and you just document that how you did it in the. You pick a random sample using Excel or whatever it was. But yeah, they still do use random tables. I had a student who was actually going through an auditing program and an internship, and he said, yeah, we have random tables that we so apparently they do still use them for some things. I kind of thought maybe in the computer age, but they still use them. Okay. So what we're going to do now is we have to find an average for each of these. So we're going to add them up. So we'll get the totals. Oops. And I'm going to be lazy. I don't know if this will... Hey, it does.
More like efficient, not lazy.
I'm gonna teach you guys how to be lazy, just like me. All right, 33,795. And let's do the same thing here. That cannot be right. Let me try that again. Okay, one of these is probably a text number. To put into a formula, it might work. So 81, 83. Still not liking it. Okay, forget it. I'm just gonna do this by hand. Oh, wait, it did take it. So why isn't it changing down there? 79.82. Here we go. 32,395. Is that what you guys got? 32. No.
So just to make sure, what are you adding up now?
The
Just-
amount. Yeah, here. I'm just going to do this by hand. This is ridiculous. I'm wasting time. See, being lazy. My don't be lazy. That's what I'm telling you today. Okay, so 81, 83. Thirty-two, 395. Okay, that is right. Yeah, this one's off by 600. This one's off by 1,000. So no, this one's off by 400. This one's off by 1,000. So it's 1,400. This is 14. Yeah, okay, that'll work. Okay, now we got to get the average. So we get the average by how? How do we do that?
Okay, so the audit amount is not the same as the book amount. For a second, I thought they're all the same.
No, this is
That's
excellent.
that's why I was getting the same amount in audit amount.
Yeah, and if you look at so these are the audit amount. Most of these we won't ever know. For instance, we didn't pick one or two, so we're not going to look that one up. We're not going to look up these or anything else. But if we did look those up, these are the amounts that we would have. Now, we would not look at all of these unless we were doing 100% of the items, which it really wouldn't be a sample. But yeah, so the items. So this is what the auditors would. So for this first one, we'd come up to they say it's 8,183. We check on it. We say, okay, you're right. It's 8,183. Same thing with number 11. They say it's 7,982. We check on it. Okay, it's 7,982.
Okay, it makes sense now. Sorry, I didn't see that. The third one was different.
Well, but this does bring up an important point, though, too. You know, the question is, which one is more, which one's more reliable? Is it the one the client gave you, or the one that you did yourself? As an auditor, which one are you going to believe more? The one that the client gave you, or the one that you came up with yourself?
Probably the ones that we counted as auditors.
Exactly. We looked at it and we came up with, no, this isn't right. This is what it should have been. Your own observations, your own calculations are more persuasive than what somebody hands you. It's like someone telling you something and you say, let me check into it myself, and you look into it and say, no, that's not right. You know. So the audit amount is the more persuasive of those two. The other one is what the client gave you. And you know, however they came up with it, don't worry about that for the sampling anyways. But yeah, and so that's what we're comparing it to. And again, these are the more persuasive of the numbers, just in general, the stuff that you came up with yourself as an auditor. Okay, wait, I got to do this. I didn't do this yet. So we're going to divide by 5. That's not an ideal sample. Okay. And so these are going to be the averages. Yeah, let me see here. $67.59. And the audit average is 64.79. Okay. So these are what we're going to, the book average here is, excuse me, 67. And the audit average is all right. So I think those two are what we're looking for. Copy these down to get on the next page. So we've taken our sample. And these are the averages we've come up with. And now we're going to do the how you expand, you project it over the entire population. We took the sample because not because we cared so much about these 5 items, but we care about the total value of what we're testing. So we're going to take these items and we're going to project it over the entire population to get an overall number of what we believe the true amount of these accounts receivable are. So we've got our sample, we got the averages, and now we're going to see how we project it out over the entire sample. And there's actually 3 different ways that we do it, and we'll talk about those as we go along. But so there's 3 different ways we're going to do it. The total of the 30 accounts receivable was 200,000, and I almost hesitate in doing this because I don't know if this is going to add up right, but just check that number. Hopefully I didn't do anything funny with the formatting on it. $200,000. Okay, so they gave us those accounts receivable, and the total of those accounts receivable was $200,000. A nice convenient round number. Looks like someone manipulated it to come out to that. Okay, so what we're going to do is do 3 different methods that we have for this, and that is we're going to use mean per unit is the first method. We're going to use ratio estimation, second method we're going to use, and then lastly, difference estimation. Okay, so we're going to use these 3 methods to kind of project it out over the entire population. Okay, so mean per unit. Mean per unit, if you think about the mean, this is just the average. Say mean per unit is the same thing as at the average per unit. So mean and average are the same thing. And the question is, again, whose average do we trust the most? Well, we trust our own average the most. So our audit average is 64.79. And what we're going to say is, look, everything in this population, there's 30 accounts receivable. Everything in this population should be off by, or should be have a value of our audit average of 64.79. So everything, all 30 accounts should have that. So we're going to multiply it by 30, and this will give us what we think our projected population should be. $194,370. Check that. So this would be our projected value. This is what we think that these accounts receivable really should be for using this method is 194,370. So this, I'm going to copy this to here. Okay. Okay, so that's our projected value. Now, what we want to do is figure out how much is, if that is our projected value, how much is this account misstated? Okay, we have a total book value of 200,000. Our projected value is the 194,370. So our projected misstatement is how much?
Sorry, I didn't realize my microphone is.
That's right. It's sneezy. It's nothing to sneeze at. Okay, here we go. So this will be 200,000 minus that. So these are misstated by I did that wrong. 5,630. Okay, so this the difference between these two will be the projected misstatement. Oops. Okay, now here's where it gets a little bit tricky. We're talking about the client's books. The client has us on the books at 200,000. We're saying that they should have on the books for 194,000. So this misstatement, this projected misstatement, is this an overstatement of the account by the client or an understatement? Are they saying their account is worth more, or is it worth less than it should be? We're saying the account should be this.
Right, so they're overstating the account.
Exactly. This is overstated. By 5,630. And again, using this method, we should all get the same number that it's overstated by. Now, is this material? Well, that's a judgment call, So let me put that in there. So is it material? That's going to be a judgment. I'll add an extra E in there. And that's just the way I am. I almost try to give you guys more. I'll give you an extra letter that other professors wouldn't throw in. Okay, so is it material? It's a judgment call. A very reasonable person might say that it is material, and someone else might say no, it's not. But we're not going to worry about it. And by the way, just so you know, the CPA exam does not test on judgment. I mean, they don't do it. At least they don't give you a number and say, is this material? I mean, they have some judgment. They say which would be most likely to detect this problem or something like that. But they don't say, okay, these are misstated by 5,630 or whatever it is. Is this material? They never do that. They may have a problem where they will actually tell you if it's material. The book is misstated by 5,000. The auditors have deemed this a material misstatement. They'll tell you if it's material, but they never give you just a number and say, is this material or not? Okay. So that is mean per unit. Let's go to ratio estimation. One second here. Excuse me. Okay, ratio estimation. Ratio estimation says that if there are things that are off on the books, that they're off by a ratio. It's sort of like saying it's sort of like this. Small things will have small misstatements. Large things will have large misstatements. Or if you have a $50 account, is that account going to be off by $60,000? Probably not. But now, if you have a $7 million account, it could be off by $60,000. That would, big numbers off by more. So the ratio says, okay, small things generally are off by small amounts, large things are off by large amounts. So that's kind of the ratio estimation. And quite honestly, it's probably the one that is most appropriate for most auditing, is the ratio estimation one. I'll talk about why in a second, or a little bit here. So anyway, let's go back to, not that. Okay, so ratio estimation. So what we're going to do is take a ratio, and we take the audit average divided by the book average, audit over book. If you forget which one goes on top, it's alphabetical. Audit over book. Okay, so, by the way, there's a lot of things in accounting that are like that. Okay, so the audit average is this. I'm just going to copy it so I don't goof it up. And the book average is this. Okay, so the book average is on the bottom. Now notice that we're multiplying it by the total book value. So it's like book, over book. So we get a ratio of the total book, which is 200,000, which is not very big for some. Let's make that a little bigger. Okay, so we're going to do this ratio times 200,000, and that's going to give us a projected value. I'm going to run it off the nearest dollar. 191.
I think it's 194.
Is it?
194 at 370.
194, 370. That's what we got for the first one.
Oh, okay, never mind.
It could be. I mean, it's not out of the question. Oh shoot, I just goofed it up. I think I got 191. I'm gonna do it again, but put this in there for now. 191, 750. I rounded off to the nearest dollar. Let me try it again.
I got the same thing you did.
You got it the same way?
Yeah, me too now. Sorry.
Okay, no, that's fine. Okay, so this is the projected value. We get the ratio, and again, this method says, okay, big things off by big amounts, small things off by small amounts. There's a difference in the errors. Larger ones will generally have larger errors, smaller ones will have smaller errors. Okay. All right, so our book value is 200,000. Our projected value is 191, 715. Put that in here for now. And let's see, the difference is $8,285. Yeah, I think that's right. So 8,285. Oops. All right, now, excuse me, the tricky part. So we're saying their books are worth 191,000. They're saying it's worth 200,000. So are their books overstated or understated?
Overstated?
Yep. Very good. Yeah. So this is we're saying it's worth 191. They have them on the books for 200. So we're saying that those are overstated by the 8,000. Again, is this material or not? Judgment call. We'll all get the same number, but whether this is material or not, it would depend on all kinds of things in the audit. How much of the accounts receivable are part of the total assets and all this kind of stuff. It could be that it's very material. It could be that it's not material at all because they have $17 million in assets, and $17 million, if it's off by 8,000, is probably not that big a deal. Okay, so that's a projected misstatement. The ratio estimation, I think this one is probably the most appropriate for most types of accounts, and I'll explain why in a second. But the idea is that, larger errors will be usually with larger items, and smaller errors with smaller items, and that there's a ratio there. Okay, difference estimation is a wacky one. All right, and we'll take it here. Sorry about that, I'm sneezing. Okay, difference estimation is kind of wacky. Here's why. Difference estimation says that everything is off by the same amount. So, a $50 account, if it has an error, that error will probably be the same as a $50,000 account. And because of that, I can honestly say that I've never used difference, and I audited for like 3 years. I never used difference estimation. Now, where that would come into play, that's not to say that it's not a valid way of doing it. Where that would come into play is if you have something that does tend to be off by the same amount every time. For instance, maybe there's a handling charge on shipments, and sometimes the handling charge gets added in, sometimes it doesn't. Maybe the handling charge is $20 per order. Okay, sometimes it gets added in, sometimes it doesn't. It could be very likely that whether it's a $50 order or a $50,000 order, that the handling charge is missing. That would be a good place to use this difference estimation, because either the dollar amounts are correct or it's off by $20. So regardless of what the size of the account, it really just depends on which is what's appropriate. Okay, so let's see, a different estimation. We take the audit average minus the book, and this is there's a couple wacky things about this, and I'll tell you why in a second. Okay, so I didn't copy that down. Hold on. I'm gonna go grab my. Okay, so we're going to take the book average. Doesn't look right. I think I got an extra row in here, maybe. All right, so audit average is 64.79, and we're going to subtract out. You get the difference between those two, and it's 67.59. And so this is what we're going to say that they should have to do to every single account is they should have to take off, let's see, 64 minus 280. Okay, so here's what we're saying. Every single account that they have, are we saying that this is the audit?
Where did you get 280 from?
The difference between those two.
Oh, okay. Okay, so you're subtracting.
Yeah. Yeah, and so it's the difference between the two. And we're saying that every one of the book value amounts should be reduced by $280. Are we saying that their book is overstated or understated?
Overstated.
Overstated, yeah. They're saying that their average is 67.59. We're saying no, your average is this. You need to take off 280 off of each of these. So we're saying that every single item in there, the 30 accounts receivable, is off by 280. $8,400. And if you don't put a minus in there, that's fine too. It means that they need to take off that much off of their book value. So this is the weird part, though. We start out with the projected misstatement. And we are saying that these are overstated. Something goofy on this. Okay, so it's overstated by this. So we come down here. The book value is 200,000. We're saying that it's overstated by 8,400. So what would the projected value be? We're saying that their book value is too high by 8,400.
$191,600.
That's a question I don't know the answer to. Yeah.
So we're subtracting the projected misstatement from the book value, right? From the total book value.
Correct. Yep.
Got it.
Yeah. Now I'll come up with our misstatement. In this case, it's an overstatement. So this will be the. And this one is the quirky one because it starts out. It gives you the projected misstatement first. Okay, so yeah, and that's an important. Let me. You'll notice on the other ones we came up with a projected value first. What did I do here? Hold on. I just did something stupid. Hold on. 600. But please change that. If you put what I put up there, please change that. The projected value is 191,600. That was the evil mark that put in that 200. My evil twin. All right, so yeah, so projected value of this would be 191. Projected misstatement would be 8,400. And again, this method says, okay, everything's going to be off by 280 on average. And again, when it's used is when it's likely that the amount that it's off by is the same regardless of the size. Excuse me. Okay, so all three classical sampling measures will give you the same value for the population. True or false? Do we get the same value, projected value?
False.
Think about it, if they were all the same, we'd only have one method, right? I mean,
But it's false, right?
yep. Yeah, they give you different ones. And again, so part of it is pulling the sample, but also part of it is figuring out which method you should use. And there's pluses and minuses to each of them. I can tell you that, and we'll talk about more about this later, but mean per unit is when everything is of similar size. So you don't have a big variation in the sample items. Mean per unit's a good one to use. I have used mean per unit in sampling. Ratio estimation, if you have ones with a bunch of different, a bunch of different amounts, it's probably the one that makes the most rational sense as far as it's, a $50 account is more likely to be off by $5, and a $5 million account is more likely to be off by whatever 10,000 or whatever. You generally don't have a $50 account that's off by $10,000. It can happen, yeah, but usually they go by size. And then the difference estimation is when the counts are likely to be off by the same amount regardless of the size. Something like a handling charge or something like that. Okay, let's stop here. Let's stop here and we'll pick this up next class. All right, so the next thing we're going to do is hopefully finish up the chapter 1 and 2 handout. So let's go ahead and take a break, and I will pull up that. That is. And when we come back, let's say be back at 2:53. Let's say 3:03.
Okay.
And we'll pick up with chapter 1 and 2 handout. Let me get 3:04. Okay, let's go ahead and get started on types of auditors. So we mostly focus on the CPAs in this class, but there are different ones. But we'll first start out with the CPA. And they generally do financial audits. That's their. They do other things too. But their license is for, just say this is licensed. But they do financial audits, and this is what we've been talking about so far in here. Oh, okay. Okay, so different types of auditors. Internal auditors. These are auditors that work inside a company. I should say business. Okay, let me clean this up. So internal auditors. Internal auditors will work inside a business. Auditors will audit operations as well as financial reporting. Certified public accounts are mostly for financial stuff, but the internal auditors will look at everything. I was an internal auditor for U.S. Steel and Navistar, and internal auditing is actually, those are pretty good jobs. Back in my day, we used to travel a lot. Now with the remote stuff, I don't know if that's as necessary as it was. You know, I'm sure nowadays you can look up records and stuff like that without actually going to the plants and all that. But they used to fly us all around. My first year, I think I spent 11 months on the road. We went all over though, but went to Toronto and San Francisco and Florida, Texas, and all kinds of places. But anyway, it was if you like traveling, I mean, it was a good job. I don't know if they do that very much anymore, but it was a good job. And by the way, back then, I don't know if it still is like this, but internal auditor jobs would come up quite frequently, and they were actually pretty good paying jobs usually, and they would just because people didn't like to travel. You know. Younger people, and like it was my first job out of college. You know, I was all up for traveling. I had never been on an airplane before, so you know, it was very. It was a lot of fun. You know, at least for a while anyway, to travel around. But anyway, that's what I did. And one thing about internal auditing, if you ever want to know how a business works, internal auditing is an excellent way to do it. And I can tell you that, for instance, working at Navistar, after I was there for 1 year, I probably knew more than almost anyone else, you know, than most people in the company. Just because you meet with so many different people, different operations, you know about, you know, the parts side, you know about the assembly side, you know about the engines, you know, we knew about everything, you know, and you knew all the people that were involved too. Another thing about internal auditing that I found kind of eye-opening was that you're basically dealing with the higher ups in the company all the time, which generally you don't for most jobs in a company, you don't do. But I think I was at Navistar maybe a couple of weeks, and I was in a meeting with the president of the company, and not like a huge meeting, not like with 500 people, but with like 10 of us of internal auditing, and we're talking with the president of the company. Most people don't do that when they're on a job for 2 weeks. You don't meet with the president in that kind of a setting. So you actually internal auditing, I found it to be a really good way to learn business and how things work, and just dealing with the different levels of the company. A lot of your testing is done at the lower levels, but your reporting is done to the upper levels, the people that are interested in what you're doing. So internal auditing is actually a pretty good one to be in. The reason I'm stopping now and telling you about it is that there's a number of those jobs out there. Internal audit, because they know so much about the company, a lot of times you'd be working with the external auditors. And at Navistar and US Steel, we had Deloitte and Touche was our external auditor. I worked with those people a lot. They like internal auditors because we know, again, internal auditors just know more about the company than anyone else. We can't do the audits because we're not independent, but we know quite a bit. So if they have questions a lot of times, and if they don't get the right answers that they're looking for, a lot of times they'll contact us, and it's not uncommon to have that we would have looked at whatever they're looking at and much more in depth. External auditors come in for 4 or 5 weeks. We're there all year round. We're there for 12 months. So we have a big advantage over the external auditors. We're not independent. We can't do an audit report, but if they have questions, a lot of times they'll rely quite heavily on the internal audit department. All right, let's go back to, okay, so internal audit, auditors, IRS auditors. And I'm going to say IRS auditors and state revenue auditors. And these are basically people that audit for taxes. The IRS are for the federal government, and the state revenues are for, so these are for auditing tax returns. You guys probably already know that. I don't know why I'm going into it, but okay, and governmental auditors. Governmental auditors are usually at the federal and they will often do auditing the GAO. I think it used to be called General Accounting Office, but maybe it's something different now. I don't know. But they will do audits, and basically they report back to people in power and say, how do you know if this Pentagon program that you're spending, $8 billion on, how do you know if it's working? Well, you send in the government auditors. The government auditors will go in and take a look and report back on what they find. For different, it could be for, military, it could be for social programs, it could be for whatever. But these are kind of people that work to make sure that the people in charge have the information, have the audits of whatever the programs that they have. It's huge. There's thousands of these government auditors because of just how big the government is. And those are, from what I understand, those are pretty good jobs to have. The governmental ones, they're very specific. We only have one Pentagon, right? So if you're doing, audits of military programs or whatever, that's it. And they're going to have their own rules. Why? Because, unlike generally accepted accounting principles or auditing principles, you don't have 5,000 Pentagons that you're going to audit. they only have one, so they have their own rules and that set up for them. But those are, yeah, governmental auditors are. Okay, question on that? All right, I think I already talked a little bit about the AICPA. I'll make this one short. They make the CPA exam. I think we talked about that. They make, what am I doing? There we go. They make the accounting standards. Otherwise known as generally accepted. GAAP. And they make the generally accepted auditing standards. Again, here's my being lazy. Also known as gas. Okay, so they make the CPA exam that every state uses. They make the accounting standards, and they make the auditing standards. Now, it's not a government agency. It is simply a club. Okay, it's a club. They have no official capacity to enforce their standards. I think I talked about that before. So the AICPA is just a club. The only part that they have is that there are people who are in power that say, hey, you have to use their standards. So the government says, for instance, for publicly traded companies, this club over here, the AICPA, they put out these accounting standards, you have to follow them. That's their, that's their problem. Now the AICPA can't say that. If the AICPA says you have to follow our standards, people just ignore it. But their power, if you like, comes from the government and the people that are in power say that people have to use their standards. So the AICPA does not have any standards. It doesn't have any power of their own. They can kick their own members out and stuff, but if you commit a crime or something, they kick you out. But generally speaking, they don't have very much power as far as enforcing auditing standards or accounting standards. Auditing Standards Board, I don't know why I have this up separately, but they make the accounting auditing standards. They aren't the only ones that make it, but they're the main ones. The big stuff is made by them. Okay, let's jump down to the Securities and Exchange Commission, SEC. Issuers. I think I talked about this last time. What are issuers?
Those who issue bond stocks.
Yep, exactly. They're publicly traded. They issue securities. So issuers issue securities, and because of that, they have to make fines. So issuers are publicly traded. Companies, and they must follow SEC rules. Non-issuers. Privately held. Um, they do not need to follow the SEC rules. If you're, so if you're IBM, you have to follow the SEC rules. If you are, Joe's hot dog stand and you're the sole owner of it, the SEC has absolutely no power over you. So the securities exchange it's only for publicly traded companies. Now, non-issuers still have to follow state laws. It isn't like they can do whatever they want. They still have to pay taxes and all that kind of stuff. But let me only change this. So the states are the ones that grant your a corporate to be a corporation, and so they can make the rules. But the Securities and Exchange Commission has no give me a second. They have no power over it. Okay. Question on that? Okay. Public Accounting Oversight Board. This is fairly new. I wish they came up with a better, commonly referred to as a PCAOB. I wish they had a little bit more, a little bit better one. I don't know what, but okay. So this is the PCAOB. Established by the Sarbanes-Oxley Act. I don't know if you guys have talked about that in your other classes or not, but the PCAOB the reporting process by issuers and registered CPA firms. And let me explain that. So PCAOB, it's actually it's underneath the SEC. It's part of the SEC. It's a subset of the SEC. And it was established by the Sarbanes-Oxley Act, we'll talk about in a second, and it regulates the issuers. So, for instance, IBM, it regulates how they do their reporting, and it registers CPA firms. If you're going to audit publicly traded companies, you have to be registered with the PCAOB. So, the CPA license is issued by the state. You can have a CPA firm in the state, and do all the non-issuers that you want. If you decide you want to do issuers, you have to get registered with the PCAOB. They will register you to do public accounting for publicly traded companies. So, they're the ones that will, and they have rules that apply to the companies themselves, like IBM, and to the CPA firms like Deloitte and Touche or whoever they're looking at. They are a very powerful group, but it's very narrow. They don't look at all things that companies do, but they look at the reporting of them issuing financial statements and the whole process of doing that. The Sarbanes-Oxley Act, you guys may have talked about this in other classes, a very important act. It was an act that was around for years and years and years, and corporations always politically killed it. So Sarbanes-Oxley Act would come up in Congress and it would immediately get killed. That happened for years. And it would get killed because companies, lobbied and said, look, we don't want this, we don't need this, blah, blah, blah. Okay, so here's what happened. Enron case. Before the Enron case hit, big frauds were in the tens of millions of dollars. Wow, this is a $10 million fraud case. This is a $50 million fraud. That's what you're looking at. Enron came out, the Enron fraud hit, and it was $2 billion. It was a big chunk of the company basically was fictitious, and it had gone on for years. And so people were really shaken by this. All right. And the the company that the audit firm that did their audit was called Arthur Andersen. If you look in the history books, you'll see Arthur Andersen. They were the largest CPA firm in the United States by far, several times bigger than the number 2 one. They were desired. People wanted to have the Arthur Andersen name linked to their financial statements. Very well recognized name, Arthur Andersen. After Enron hit, nobody wanted Arthur Andersen's name on their audit reports. They were seen as, again, this is one company, one group of auditors and whatever, but the entire largest CPA firm in the United States basically went out of business because no one wanted to have their name, the Arthur Andersen name. It was like overnight, the Arthur Andersen name became mud, and you did not want to have it. It literally killed a huge CPA firm, the biggest. Now, all of those partners, they generally kept all their clients. They just went to different CPA firms, and they took their clients with them. So they're working at other large CPA firms, but the Arthur Andersen, business went out of business. It was very straight. So anyway, so about a year passes, and it's kind of settled down a little bit. And then the WorldCom case hit. WorldCom was even bigger than Enron. It's not as well known because it came in second, for large fraud cases, but it was actually larger than, the Enron case. So the WorldCom case hits, and all of a sudden, no one trusts the financial statements anymore. So like a year later, they like these two giant, companies, and you can't trust anything. And so the market started to fall because investors really didn't trust the financial statements. Okay, bring us back to the Sarbanes-Oxley Act. The Sarbanes-Oxley Act was something that already was ready to go, and companies were then like, put that act through, because they needed to have that restored to the market. Their shares of their stocks were tanking because no one trusted the financial statements. They put out record financial statements, and the stock price would drop. No one trusted them. So the Sarbanes-Oxley Act came back, and it came back ironically because the companies now that were lobbying against it really wanted it. So that's kind of what happened with the Sarbanes-Oxley Act, and that's how we got the PCAOB. And kind of like the rest is history. But it actually did some good things. Every now and then you'll see someone talk about repealing the act. But anyway, okay. Let's go to 5 and 6. Which of the following organizations can license certified public accountants? Did we do this one? I can't remember. So who licenses CPAs?
The Illinois CPA Society?
Yep, states.
States, got it, yeah.
Yep. Yeah, whatever state you're in. So yeah, Illinois would be the Illinois Accounting Board. The accounting board generally. So every state's going to have their own accounting board, and they are the ones that can issue CPA licenses. And they're generally the ones that can revoke them. So the federal government cannot revoke your CPA license. The AICPA cannot revoke it. Securities Exchange Commission, Public Accounting Oversight Board, they cannot do anything about it. Now, the Public Accounting Oversight Board can pull your registration. You recall it, I talked about how you have to be registered to do audit publicly traded companies. They can pull that registration if you're really messing up. They can pull your registration so you can't audit publicly traded companies. But they can't take your license. Only the state can take your license. They're the only ones that issued it. So they're the only ones that can take it away. Okay. CPA firms. CPA firms. It's on 1 page or 2 page. I don't know. Okay. Generally speaking, so this is kind of how it works out when it comes to CPA firms. Small businesses that get audited or need some kind of to use a CPA. Smaller clients, you go to smaller CPAs. Larger clients go to larger CPAs, and there's a real reason for that. Large CPA. Let's take large CPAs first. If you're auditing a company that's worldwide, let's say you're auditing Ford, who has manufacturing and distribution all over the world, probably thousands of different things all over the world. You need to have a CPA firm that has offices all over the world. You can't have some 10 people in Illinois audit Ford. It's impossible. So larger CPA firms will do larger clients. So the large companies will have large CPA firms do their audits because, again, oftentimes they're international. They're certainly in every state in the United States, and they're oftentimes all over the world. So they can't have a local CPA firm do that. So they generally go by size. Hold on 1 second, you can't see what I'm seeing. Okay, so local firms, these will usually have, say, 1 to 3 partners. Maybe more. It can be more, I guess. I like say 5 partners. And they generally do smaller businesses. A lot of times they don't do as much auditing. They will oftentimes do accounting services. Oops. They'll do taxes. maybe a little bit of consulting. And they could do audits, but it's probably not it's most likely not their bread and butter. It's most likely probably not what their main revenues come from. But usually, say 1 to 5 partners, and they usually do smaller things. Regional firms. Regional firms will usually have several partners. Say, I don't know, 5 to 20 partners. And they'll do sort of the medium-sized businesses. In a region. So for instance, hey, what did I do here? I don't know how to spell Illinois. I already know. Oh, I did. Okay. So for instance, maybe they operate in Illinois, Indiana, Wisconsin. And they will do some audits. They'll do the same things up here, but they'll also do audits will be more along the lines of what they're doing because, well, first of all, the companies, these might be companies that plan to go public, but also as they get larger, their financial statements, the bank might need their financial statements. And if they get to a certain size and it starts to get, let's say their loans start to be in the millions, not in the hundreds of thousands, you start getting loans of $5-6 million, the banks want to see audited financial statements. So it is very possible that regional firms get audited. And as they get more investors, the more investors you get, the more likely you are to have audits and all that kind of stuff. So it's kind of like the next level up in that they are actually starting to get some need for audits. Not all of them, but several of them may very well need audits. And you'll still keep the accounting and taxes and that sort of thing, the consulting part of it, but more and more getting into the audits. Okay. National firms. These could have hundreds of partners. And these generally are in most states. And they will concentrate much more on, almost all of these will have, their clients will usually have audits. Many of them will anyways. Oops. Tax services. Oops. Consulting. And at this point, they probably have fewer of the accounting services. These are people that usually the larger companies that go to them, there'll be companies that are in most of the states, most of the at least continental states, and you'll stop kind of doing the accounting services. You stop keeping track of their books. They usually are big enough that they do their own. These are companies that very well, some of them might be issuers, publicly traded. This is where you're getting into the size that you could definitely have companies that are either issuers or planning on being issuers, that they're trying to get their stuff together to get publicly traded. So these national firms, these are starting to get larger. National firms, thousands of partners all over the world. Some firms all over the world, and they generally do the larger. I just say the largest. Um, Largest company audits. Now, that there's pluses and minuses to all the size of the firms. If you're planning on going into audit into CPA work, there's some local firms that are very profitable. It doesn't necessarily mean that you don't make as much money. Now your clients are usually not as big, so the individual clients, you're not going to be able to charge as much. But overall, yeah, you can do it. We have the big four firms: Deloitte, PricewaterhouseCoopers. That used to be two different groups. KPMG, that used to be two different groups, and Ernst and Young. Those are the big four firms. When I was going through, there was a big eight, so they've kind of condensed down. But yeah, so these are the big four firms, and a lot of times the big four firms are what people focus on. Although I do have to say the national firms are also very very good. There's excellent national firms that are really their name carries quite a bit. So if you're looking to get into auditing and you do that through the internship, I think I talked about that last time, that if you want to go into auditing, you generally get an internship with the firm that you plan on working with. The national firms, and I can put out a list of those, but the national firms are really good to be with. Generally, what a lot of times companies will want are the people who have dealt with being issuers. So a lot of times in accounting departments of larger companies, if they're looking for people to come from the CPA firms, they're looking for the more regional. If they're a large company like IBM, let's say, they're looking for the regional or big four experience. And the reason for doing that isn't because they're snobbish. It's because that's who they have to deal with. They have to deal with the PCAOB, they have to deal with the SEC and other government agencies and all that kind of stuff. And so that's why they kind of look for auditors that have come out of the national and big four firms, if they are issuers, if they're big companies. If they're not big companies, it doesn't really matter. But yeah, so sometimes there is a leaning towards that of the larger firms if you're going to be in larger companies. And again, just because that's their business, that they're in the business, that they have to deal with the Securities and Exchange Commission and the PCAOB and all that kind of stuff. So the people who can. Okay. Which of the following type of CPA firm would be appropriate to perform an audit of a bakery that has operations in Illinois and Indiana?
Local firm?
It could be a local. If it's in more than one
Regional.
state, it's more than one state, usually a regional, but it could be. It could be that it's a local firm too. Certainly, if you live near the border of Illinois or Indiana, you're probably going to get clients on both sides. So it could very well be.
So what would be the difference between regional and local?
Regional usually has more than one state. There'll usually be a number of states. Whereas local, a lot of times will be in one state, and a lot of times even just in one city. If you're a local firm in Orland Park, you probably have smaller businesses that you work with, and some other clients you'd probably do taxes with. But everything's pretty much in Orland Park. And again, there's nothing wrong with that. And it's a very, if you want all aspects really quick, and you get your CPA license, you can do that. Once you get your CPA license, you can hang out the shingle and become an accountant on your own. And one of the cool things about it too is if you do that, you can also work a job on the side, or maybe your main job, and then do it on the side until you get enough clients that you can actually quit your main job and just go right into being a CPA, with your own business the whole time. So
can a firm from Indiana perform an audit in Illinois, in a different state?
Yes.
Yeah. Okay.
Well, there's a couple. First of all, there's a couple different ways to do it. it could be that the CPAs get licensed in both states, which isn't hard.
Mm.
You have to pay.
Mhm.
You have to pay the extra amount, whatever it is, $300 or something, every 3 years, I think. But yeah, so they could do it that way. You can also apply for, and this is usually done on I think like a 6 month basis, to allow you to go in and do an audit with a license from a different state. And I think they usually have a term like 6 months or something like that. And
Mhm.
that you don't have to be a licensed auditor in that state. You can simply get a, whatever they call it, a waiver or something like that to go in and do the audit. If you did a lot of them in both states, you'd probably just want to be licensed in both states. But if you only do a couple of them, you can actually get a waiver.
Okay, thank you.
And again, there's usually a time frame to it, though. It's like you can do for the specific client for 6 months or whatever. But yeah, it's much better now than it used to be. When I graduated, every state was different, and you could not. It was really hard to transfer to different states.
Mm-hmm. Mm-hmm.
Now they kind of, it's much more. It's much easier to do now.
Yeah, I hear they simplified a lot of things.
They definitely did. They definitely did. And they were.
Okay.
Yeah, yeah. And part of it was that actually it was the state board of accountancies that were kind of getting together, because you got to realize that, I mean, they were going through all kinds of headaches and jumping through hoops and do testing and all this other stuff. And finally they just said, okay, you know what, this is ridiculous that we're all spending all this time doing this. Why don't we just have it a little more easy that we can actually, transfer from one state to another. They're all taking the same exam, so there's no problem with it. Okay, let's go through. Maybe we'll finish up there. We got 14 minutes. Let's do it. Come on, guys. All right. So let's look at the kind of the differences between the groups. American Institute of Certified Public Accountants. They make rules for. Now again, they don't enforce the rules, but they make rules for.
Okay.
They make them for everybody. And by the way, even though the government, the PCAOB does a lot of the rules for, they make their own rules. They also will tell the companies, the issuers, that, oh, by the way, you also have to follow these AICPA rules. So the federal government actually tells them, now if there's a difference between the federal rules and the AICPA rules, federal rules win out, but they are required to follow the AICPA rules. Okay, is it a government agency?
No.
Yes.
Actually, no, they're not. No,
They're just a club.
Exactly. Yeah, they're a club. Yeah, when you pass a CPA exam, this is a club for CPAs. Keep them off the street, Yeah, so if they have no government authority. Can they issue or revoke CPA licenses?
I think it's rather interesting that they have no government authority, but it's like the exams are so thorough. There's like so many laws and regulations that you need to know and pass to become a CPA. But like if you're part of the association, it's not government.
Yeah,
kind of throws me off for a second.
Well, and the thing is the CPA that they make is very thorough, and it is aimed at licensing CPAs. So it is CPAs who went through the licensing process making the CPA exam for a licensing process too. But yeah, they have no government, and they'll issue they'll administer the CPA exam. They'll grade the CPA exam. If you fail the CPA exam and you say, I'm going to sue you because I don't think I should have failed, you're not going to sue the state of Illinois. You're going to sue the AIC because they're the ones who graded it. So, there is a separation that I think the states like, that, hey, we're you can't come back to us. We're not the group that makes the CPA.
Mhm.
But also that it is very thorough, and anything a state would want is basically in there. So, yeah, and again, any state could say, we're not going to use your exam. It's up to the state to do that. But again, I seriously doubt anyone will, but they could. You know, it's not. Okay, do they register CPA firms? Nope. Creates the CPA.
Yes.
Will they do that? And again, they make rules for issuers, non-issuers, and issuers. However, the issuers are usually covered by the PCAOB, but they require. But non-issuers, it's a little bit looser. But a lot of times, the rules that they make for non-issuers become state laws. So there are sometimes that these will actually become state laws, not enforced by the AICPA, but by the state. Okay, state laws. Oh, here, I have right here, many based on CPA rules. Okay. They make laws for both non-issuers and issuers. Just because you are an issuer does not mean you don't have to follow the state rules. If they have laws that you need to follow, then you need to follow them. Are the states a government agency?
Yes.
Yep. They issue and or revoke licenses.
Yes.
Yep. Register CPA firms for issuers. No. That's what the PCAOB does. These people down here. Creates a CPA exam.
No.
Yeah, CPA creates it. They tell people that they have to take it to get licensed, but they do not create the exam. Okay, so state laws. Okay, PCAOB. They make laws for. It's only one of them.
Just the public?
Yep, exactly. Just the issuers. If you're private, Jenny's hot dog stand doesn't matter. They have no power over you. If you're IBM, they have power over you. Is a government agency.
Yes.
Yep. Yep. They are a public agency. They have the power of I don't say life and death over companies, but they have quite a bit of power over companies. Do they issue or revoke CPA licenses? Nope. There's only one place that does that. That's the states.
No.
They do not do that. They register CPA firms for issuers.
Yes.
Yep. Yeah. So if you want to do audits of publicly traded companies, you have to get registered with the PCAOB. Create the CPA exam. That's what our club does. Okay, so these kind of things. So the big thing is states are the only ones that can issue revoke licenses. The AICPA has no official regulatory authority. They're not a government agency. They can kick their own members out. If you're a member of the AICPA and you do something crazy, they'll kick you out. But other than kicking the members out, there's nothing they can really do. They can't take your license. They can't revoke your registration or anything else. Okay. You know what? I'm going to stop here. Yeah, we'll finish up next time. So here's what we're going to do next class. Let's say stop here. Okay, so next class, we will finish 1 and 2, I promise. We'll also do some CPA questions, so you get kind of used to seeing those. CPA question review for chapter 1 and 2. And we might start chapter 3, we'll see. And we'll also work on the classical sampling. And I'm going to give you a little bit of homework for the see if you can try this one. So homework, go to the classical sampling number 2. And see if you can do it. Now we'll go through it in class, but just see if you can do it on your own. The nice thing is they've already given you the sample. You know, this is what the total sample is. The 10 accounts they picked for the sample. These are the, and by the way, number 2 is something similar to what you might see on the CPA exam. This is kind of the format that they would do on the CPA exam. This first one here is a little bit too involved in picking the sample and all that, but this is something they would give you on the CPA exam. So see if you can do number 2 and do the, you know, the 3 methods for it. Don't be afraid of making a mistake. We'll go through it together, and you know. So for next class, try classical sampling. Try problem 2. And again, don't be afraid about making a mistake. You know, we're going to go over it. So, and you know, we've only done one of them, so we're going to do more. But see if you can get through problem 2. See if you can figure that one out. And again, don't worry about making a mistake. We'll go through it. So, you know, any questions?
Do we need to upload the homework through the Blackboard?
One more time?
Do we need to upload the homework, the problem through the Blackboard, or just work on our own and then check in the class?
No. You don't turn anything in. Just do it. Your handout. When we finish this handout, we'll turn it in total. So just do it in the handout.
Thank you.
Yeah. You don't need to turn it in yet, and that's why I'm saying that, you know, don't worry about making a mistake. We are going to go through it before you know, and we'll finish the rest of the handout also. But see if you can do number 2, and yeah. Any other questions? Okay,
No.
and next week I promise we will get done with chapter 1 and 2, and then we'll also do the CPA questions. And next week I'll send out the chapter 1 and 2 exam, and it won't be due for like a week and a half. So next week, the 31st, it'll be due on the 9th, I guess. Yeah. Oops. What I did there. Anyway, yeah, any questions? Okay, yeah, so give number 2 a shot on classical sampling, and again, don't be afraid of making a mistake. We're gonna, you know, again, first thing in class, we'll go through it first thing in class. We'll kind of go through together the problem number 2, and yeah. Okay, well, and hopefully, I'm very hopeful now, because I've, you know, this week you know, 2 of the classes have gotten into the Laker bundle. Unfortunately, yours is the only class, the larger class so far, that hasn't gotten in yet. But hopefully, I'm hopeful that within the next day or 2, we'll get the Laker bundle thing sorted out. Any questions? And when it is sorted out, I'll let you guys know, so that you can actually get in and get access to the book that you paid for. Any questions? Okay, well, I will see you guys next week.
Good night.
Thank you. Take care. Thanks, Professor.
Thanks, guys.
Have a good night. Thank you.